Many investors are intimidated by unrelated business income tax, or UBIT for short, leading them to sometimes make investment decisions focused on avoiding the tax rather than growing their retirement account. That reaction often comes from not fully understanding how UBIT actually works. In reality, UBIT is more predictable and limited than many actually expect. It doesn't disqualify an IRA, and it doesn't mean that an investment wasn't structured correctly. In many cases, UBIT appears when an investor begins using more advanced strategies such as leverage or participating in certain types of business activities. In this episode of Getting Real, we're walking through what triggers UBIT, how it's calculated, and when it applies. So let's get started. UBIT is typically triggered in two situations. The first situation is when income is generated from an active trade or business activity. If an IRA invests in an operating business through an LLC partnership or limited partnership, there could be the potential of unrelated business income tax depending on the activities of the entity. The second is debt-financed real estate investment acquisitions or the improvement of real estate using debt. This occurs when an IRA uses a non-recourse loan to acquire an investment property, such as a rental property or potentially a fix and flip transaction. It would also involve investing in a real estate partnership, sometimes referred to as a syndication. In this case, the portion of income attributable to the finance percentage is subject to unrelated business income tax, also referred to as unrelated debt financed income tax. For example, if an IRA purchased a $200,000 property using $100,000 from the IRA and $100,000 in debt, that would be approximately half of the income subject to unrelated debt financed income tax. So these types of strategies are not unusual. In fact, they're often used to increase the purchasing power and expand investment opportunities within an IRA or solo 401k plan. A client of ours owns a rental property inside of their IRA that generates approximately $72,000 in annual income. Now, after expenses of about $67,000, the net income is roughly $4,800. Now, if 60% of the property is debt financed, then 60% of the net income, about $2,900, is subject to unrelated debt financed income tax. After applying the tax rates and deductions, the total unrelated debt financed income tax owed in this scenario is only approximately $236. From there, the remaining income continues to grow in the IRA with their tax advantage treatment intact. Even with UBIT, the underlying investment continues to perform as intended. The property is generating income, building equity, and operating within a tax advantage structure. UBIT applies only to the portion of the income tied to the leverage, not the entire investment. That's really important to understand. And as a result, the majority of the income retains its tax advantage status, and the overall strategy can still support long-term growth within the IRA. And remember, speak to your tax consultant or tax professional regarding a solo 401k plan, because in many instances, when investing in a debt finance real estate syndication or investing in property directly utilizing a solo 401k plan, you'll be exempt from that unrelated debt financed income tax. Again, see Section 514C9A of the tax code. So let's get real. UBIT is not a penalty or an indication that something has gone wrong. It's a tax applied when leverage or an active business occurs in an IRA account. For many investors, UBIT or UDFI simply reflects the use of the strategies designed to increase opportunity and scale within a retirement account. The important consideration is not whether UBIT exists, but how it affects the overall return on investment. In other words, look at the taxes that you would owe, and then calculate that into your overall return on investment. Understanding when UBIT applies and how it's calculated allows an investor to evaluate opportunities more clearly and make decisions based on the overall outcomes rather than just assumptions or guessing. The goal is not to avoid UBIT at all costs, but to determine whether an investment still makes sense after accounting for it. For investors using leverage or exploring more advanced strategies, UBIT is often just one component of a broader investment approach. If you want to better understand how UBIT could apply to your specific situation, connect with an IRA counselor at Equity Trust to walk through your options and considerations. And hey, if you like today's video, don't forget to subscribe and hit the bell icon to get notified every time we post a new video. I'm John Bowens at Equity Trust. Thanks for watching, and we'll see you next time.